Hello again. Can you see the screen now? What I have on the screen, the PowerPoints?
Yes,
Yes,
yes.
yes.
All right, good. So this is one of the glitches of technology. I guess I had to go all the way back and start all over again for some reason.
Professor,
Yes,
the homework too is due today, right?
yes. The
Okay.
homework is due on the 12th. Today is the 12th, right?
Yeah, it's due at midnight today, right?
Yeah, that's right. So don't worry if it
Okay.
says, you're late. Just ignore that. Don't worry about it.
Okay.
Okay, so today what we want to do, we're going to start a new chapter. That's if no one has any questions. Let me answer any questions that you may have before we start. So we can get that out of the way. Okay, so I guess no one has any questions. Okay. All right. Today, as I said, what we will be doing is basically going over chapter 11 of your book, which deals with foreign exchange. Basically, that's what this chapter is all about. So there you go, chapter 11, foreign exchange. And in just a few minutes, I will tell you exactly which topics in this chapter we will be covering and which topics we will be skipping. So this will make it a lot easier for you when it comes to exam time to prepare. You should know exactly which one to focus on. Anyway, before I do that, let me just give you a brief prelude to this chapter, foreign exchange and why it's so important. In other words, what makes international economics different and unique from other subfields in the economic firmament, such as labor economics, urban economics, monetary economics, managerial economics. So there are so many fields in economics. And international economics is, as I said, is pretty much different and unique in the sense that it espouses, if you will, the existence of the different national monetary units of account. This really makes it extremely important for us to understand or to study international economics. Is this existence of these different national monetary units of account. And if you remember all along, we have shown how the current account deficit or the trade deficit for that matter will affect aggregate income, will affect aggregate production. In other words, it will affect the entire macroeconomic balance of any economy. And the exchange rate has a lot to do with what happens to your current account deficit. The exchange rate has a lot to do with what happens to trade in goods and services, to investment, and to also trade in various assets, financial assets. So the exchange rate is extremely important. And for that reason, international economics becomes an extremely important and unique aspect of all of economics. So, for example, in the US, prices and money are measured in terms of the dollar. And this is very similar to Europe. Prices and money in Europe are measured in terms of the euro. Prices and money in Japan are measured in terms of the Japanese yen. So this unit of accounts, or this monetary unit of accounts, in other words, the money that we always refer to, is extremely important. And international transactions usually require two distinct purchases. In all international transactions, you will be required to make two purchases. The first one is you need to purchase the foreign currency in foreign exchange markets. That's the first step. Secondly, once you got that currency in your hands, then you will use that currency to purchase the goods that you desire. So you can see here, international transaction will require always two distinct purchases. Now, all this has to be done in an institutional arrangement that will provide an efficient mechanism which will settle all the monetary claims on both sides with the minimum of inconvenience. So in order to do all of this international transactions, all this international trading, and whether it's goods, services, assets, all of this has to be done within an institutional arrangement. You have to have this institutional arrangement, which we obviously call the foreign exchange market. This institutional arrangement will provide an efficient mechanism that will settle all the monetary claims that you may have between different countries with the minimum of inconvenience. So this is basically, I hope I summarized very quickly for you the importance of this chapter. Now, the other thing that I want to say here is that the first chapter, chapter 11, because all the subsequent chapters are going to be dealing with the exchange rate. But the first chapter, chapter 11, will only look at the nature and function, if you will, of the foreign exchange market. The nature, the importance, the function of the foreign exchange market. So this chapter is pretty much highly descriptive in nature. Whereas the subsequent chapters, chapter 12 and on, that will really take us more deeper into analyzing the effect of foreign exchange on the total economy. So we will be talking about policies that we may use in order to make sure that the foreign exchange does really not get out of control in affecting the very livelihood of our economies. So we really have to have different policies in place to make sure that, again, the foreign exchange or the price of one currency in terms of another is pretty much kept under control, because if not, then obviously this will affect your economy negatively in terms of production, income, employment, etc., when you become less competitive with the rest of the world, simply because your currency now is much more expensive than other currencies. So you don't want to be put in that position. You don't want to be put in a position where your currency appreciates at such an alarming rate, becomes extremely strong. You don't want that to happen, because if that happens, then you will fall at the mercy of other countries in terms of trade and competition. So you want to always be very, very competitive with other countries in terms of selling goods and services overseas. So the exchange rate here is extremely important, and we have to find ways to actually control the price of our currency in terms of other currencies. So that's basically it. Okay, now, what do we want to do in this chapter? The first thing we want to do, as I said, we want to talk a little bit about the foreign exchange market and what it is. Then we want to look at the types of foreign exchange transactions. Interbank trading, we're really not going to focus on that, so you may as well forget about that. Reading foreign exchange quotations, we will refer to it, but we will not again immerse ourselves in it deeply. Forward markets, yes, we will look at that. Future markets, no. We will skip future markets. We will only look at forward. Foreign currency options, we will skip that. We will look at exchange rate determination. We will skip the index of foreign exchange value. Don't look at that at all. We will look at nominal and real exchange rates. Yes, that's important. We will look at arbitrage. That's important. In fact, we will spend some of this chapter as well as some of the next chapter to pretty much explain and go deep into the concept of arbitrage and what it means. And you will find it that it's highly illuminating to pretty much understand what is meant by arbitrage and how it affects the equilibrium in financial markets. Even though your book really doesn't spend much talking about arbitrage, but I do like to spend some time on that. And for that reason, I will post some of the notes that I have from my book, which should help you tremendously in understanding the mechanics and dynamism of arbitrage, what it's all about. So, in fact, we will be looking at financial markets, basically, and equilibrium in financial markets. What brings equilibrium in financial markets? So there are a lot of things that we need to look into, and your book, unfortunately, lacks that. It doesn't look at it at all. It simply looks at arbitrage from the surface. It really doesn't go deep into it, but we will. Okay, the forward market, yes, we will look at that. Interest arbitrage, currency risk and hedging, we will look into that. These two we will not really focus on. Foreign exchange market, foreign exchange trading as a career, we will skip these two. Okay, so that's basically all that I want to say as far as this chapter is concerned. So let's get started here. The first thing, of course, we want to look at foreign exchange markets, what it is. Like your book says here, it's nothing but an organizational setting. It's an institutional setting, the one that I just talked about in my prelude to foreign exchange. That includes all players. Now, who are the players in the foreign exchange market? Well, players are individuals just like you and me, businesses, governments, and banks. All of these players are pretty much involved in buying and selling foreign currencies and also other debt instruments such as bonds, stocks, etc. Now, the foreign exchange market is the largest and most liquid market in the world. In other words, the foreign exchange market dwarfs all other markets, like the labor market, the goods market, the capital market, the financial market. All of these markets are pretty much dwarfed by the foreign exchange market. And when I talk about the financial market here, what I'm talking about, even though the foreign exchange is part of it, but when I talk about the financial market, what I have in mind is simply the bond market and the stock market, basically. So the foreign exchange market is by far the largest and most liquid. You know that today, I guess, if you want to look at the volume of trade in foreign currencies in the foreign exchange market on a daily basis, this probably amounts to about $8 trillion worth of trade in foreign currencies. That's how much the foreign exchange market is responsible for. $8 trillion a day on average. That's a lot of money. That's why we say the foreign exchange market is the largest and it's the most liquid market in the world. Now, the foreign exchange market is dominated by four currencies, basically. You have the US dollar, the euro, the Japanese yen, and the British pound. Now, that does not mean that there are no other currencies involved in the foreign exchange. Yes, there are. There are plenty of other currencies included in the daily transactions. However, the most important currencies, or the ones that actually dominate trading in foreign exchange market, are these four currencies. Now, some currencies are basically completely ignored, and you will not find them being traded in the foreign exchange. And the reason may be political instability in those countries. It may be because of economic uncertainty in those countries. And sometimes also it may be because those countries do not produce goods and services that the rest of the world desires. So in other words, if that country is not producing any goods that we want, so why do I want to buy that country's currency? Because basically the reason why I want to buy that country's currency is simply because I either want to buy goods from that country, or I want to invest in that country, buy bonds, stocks, what have you, or even have direct investment. In other words, building factories or whatever the case may be in that particular country. So some countries probably will not have their currencies traded for those simple reasons that I have just cited for you. Okay. The three largest markets in foreign exchange are located in London, New York, and Tokyo. Those are the three largest market centers in as far as foreign exchange markets are concerned. Again, this does not mean that foreign exchange markets exist in only those three countries. No, we have other foreign exchange markets as well. In Australia, in Canada, in Switzerland, in Germany, in South Africa, in Singapore. So, we have these foreign exchange markets everywhere, basically. But as I said, the three largest are the London, New York, and Tokyo foreign exchange markets. Now, foreign exchange markets pretty much work at basically three levels. The first one is you see a lot of transactions taking place between commercial banks and commercial customers. So that's one level. The other level would be between domestic banks themselves. So we have what we call a domestic interbank market. Like, for example, Bank of America wants to buy foreign currency, doesn't have enough in its vaults or in its reserves, so it asks Wells Fargo or Citibank or any other bank to actually sell them some of the foreign currencies. So, this is another level whereby you see foreign exchange is being transacted. The third level, of course, is trading in foreign exchange between banks here, businesses here, with banks overseas. So those are three levels at which this really take place. Now, obviously, we have three types of transactions that take place in foreign exchange markets. Those are called spot transaction, forward transaction, and swap transactions. Those are the only three types of transactions that we are interested in. Now, there may be some other. We're really not interested in them. So I'm really not even going to talk about them. So the only three that we want to talk about here are spot transaction, forward transaction, and swap transaction. Now, each of these has its own market, has its own exchange rate, and has its own regulations and stipulations. So let's first start with the spot transaction. What do we mean by spot transaction? Spot transaction simply refers to the buying and selling of a foreign currency on the spot or for immediate delivery. So if you want to buy a foreign currency right now on the spot for immediate delivery, you go to the spot market and you make a spot transaction and you will pay a spot exchange rate. Okay, so that's basically what we mean by spot transaction. Very simple, very easy, straightforward, no complications. Now, there is also another type of transaction, which we call the forward transaction. Now, what does this mean? This simply means that suppose you are a US firm and you want to purchase, let's say, $10 million worth of laptops from Germany. And you will get delivery of those laptops in 3 months. So you are only obligated to pay for those laptops in 3 months. So the German firm is going to tell you, okay, in 3 months, I want you to deliver 10, let's say, for example, if the computers or laptops were worth 12 million euros, they will tell you, okay, we need you to send us 12 million euros in 3 months' time. So now what do? Do you go to the spot market and buy 12 million euros and put those 12 million euros in a bank and get probably some interest on them for, I don't know, 3 months, and in 3 months' time, you simply take those euros, give them back to the firm that is selling you the computers, and pocket the rest, the interest that you have gotten. Now, this is one way to do it, probably. The other way, of course, is to simply wait, and in 3 months, you go again to the spot market in 3 months and buy 12 million euros and give those 12 million euros to the German company. So there are options. And the other option, of course, is to keep that money. You could work with it because you need it for many purposes. And in 3 months, go to the forward right now, for example, go to the forward market right now. Go to the forward market and purchase 12 million euros to be delivered to you in 3 months, and you don't have to pay anything now. You will pay that in 3 months, but you got to make a contract right now in the forward market. You got to make a forward transaction. You got to write a contract that you will purchase those 12 billion euros or whatever it is that you want to purchase in 3 months. And this is called the forward transaction. So obviously you have options. Now, why would you opt for this option, going to the forward transaction? In other words, going to the forward market, purchasing 10 or 12 or whatever it is, million euros, and paying for them in 3 months at the forward exchange rate. Now, the forward exchange rate, you will know the minute you sign a contract. So you don't have to wait for 3 months to know exactly what the forward exchange rate is. The forward exchange rate will be given to you the day you sign the contract. And you're going to be signing the contract today in the hope that you get delivery of those euros in 3 months. But the price that you will be paying for those euros will be determined by the forward exchange rate, not by the spot exchange rate, because the spot exchange rate could be something completely different from the forward exchange rate. So why would you want to do that?
I think it can save you some money. Let's say like the spot exchange rate increases. So it would be, if your forward rate is cheaper than it could be cheaper than the spot exchange.
Yeah, that's true. It could be a lot cheaper, but then again, it could be a lot more expensive, by the way. So it all depends, because you have no idea what's going to happen to the spot market in 3 months from now. In other words, the value of the euro could go up or it could go down. Now, if the value of the euro goes down, that's in your benefit. So you can buy more euros with few dollars. But what happens if the value of the euro goes up? Now you have to cough up more dollars to buy those euros. So in fact, there is no way of telling what's going to happen to the spot exchange rate 3 months from today. You don't know. So you're taking a risk. Yes, it could work in your favor, but then again, it could also work against you. That's why there is a risk. It's like, for example, investing in the stock market. You don't know what's going to happen to the price of the stock. It could go up. If it does, hey, you're a winner. But if it goes down, you're going to lose big time. So you don't know. I mean, there is a risk involved. And that's the reason why you want to go to the forward market. You want to go to the forward market because you want to lock in the exchange rate. You want to have an exchange rate price that you can live comfortably with. In other words, there will always be a fee that you have to pay, of course. I mean, nothing comes cheap. There is a cost to everything, but at least you can live with that cost. In other words, it's minuscule compared to what would happen if the euro happens to appreciate in value. Then you would really be in a bind. It would really cost you a lot to buy those computers. So at least now, when I go to the forward market, I know exactly how much those computers are going to cost me. Pretty much, even though I have not paid a penny yet. But I can plan exactly what I need to do. And as far as pricing is concerned and everything else is concerned, I can plan from now. simply because I have bought the euros in the forward market. I have a forward transaction which will lock in the rate that I will pay for the euros in 3 months. And that rate, I know exactly what it is. I can put it into my calculations when it comes to pricing and when it comes to knowing whether I'm going to be competitive or not, etc. At the same time, I don't have to pay a penny right now. I'm going to use all that money for internal purposes within the firm to actually try and probably enhance certain things within the firm. So, firms always find the need for cash flows, liquidities, and what have you. So, yeah, this would be a good idea. However, suppose the euro depreciates in value. Well, if it depreciates in value, there is nothing you can do. You probably be a loser there. Because once you sign in the forward contract, you really can't get out of it. You can't say, well, you know what, I changed my mind. Now I want to go to the spot market in 3 months and buy my euros there. No, you can't do that. Once you sign a forward contract, that's it. So again, there is a benefit and also there may be a loss. But the good thing about the forward transaction is that you know exactly what's going to happen. Everything is clear in front of you. There's not going to be any risk. You have obviously pretty much eliminated the element of risk. So that's basically what a forward transaction is. As your book says, receiving or paying an amount for, I guess, let's see here. So we can read it better. Receiving or paying an amount of foreign currency on a specific date in future, months to years from now. It will have a fixed exchange rate. It will protect you against unfavorable movements in exchange rate, but will not allow any gains to be made should the exchange rate move in your favor. This is exactly what I meant, basically. So, I mean, there are certain advantages from having a forward transaction, and that advantage would simply lock in the exchange rate, so you don't have to worry about obviously paying too much for the euros in 3 months' time. You know exactly how much you will pay for them, and you will pay for them based on what the forward exchange rate is, and that will be given to you from day one, the day that you sign the contract. Now, obviously, forward transactions can be made for 30 days, 60 days, 90 days, or 180 days in advance. And you can lock in the exchange rate for those different periods. Now, each period, of course, has its own forward exchange rate. So for a 30-day period, there is a given forward exchange. For a 60-day, another. 90 days, another forward exchange rate. 180 days, another forward exchange rate. So it all depends on the period that you choose to purchase the foreign currency. And again, it makes sense for a lot of firms to actually engage in forward transactions, as I said, because it simply eliminates any risk, and it makes trade in goods or trade in services or trade in financial assets a lot more smoother, and businesses can plan ahead of time of what they need to do because they have all the information available to them. They don't have to be involved in any kind of guesswork. This is important. No guesswork here. Everything is given to you right at the beginning. So you know everything, and based on that information, you can go to the drawing boards and start making your plans. Okay. And then, of course, we have the currency swaps. Again, this can be summarized very, very easily, even though your book probably spends a couple of pages trying to explain this, but you don't need to do that. You probably can define and explain currency swaps in just a paragraph or so. That's all you need. What it means, basically, it's a combined, or it's a combination of spot and forward transactions. In other words, spot and forward put combined in one. And this is known as currency swaps. Let me give you an example. Suppose you want to invest in a euro bond that matures in 3 months. So you go to the spot market. So here, of course, you will be engaged in buying euros today at the spot exchange rate, whatever that is. And you will also be purchasing, or you will be making a forward transaction in terms of selling euros for dollars in 3 months' time. In other words, once the bond matures, you're going to be getting your euros plus the interest that you got in your bond, and you want to transfer that money back into dollars. And that will happen in 3 months. So what you do is you buy what we call a currency swap. In other words, you buy euros today at the spot exchange rate, and you sell those euros in 3 months' time back to dollars at the forward exchange rate, whatever that forward exchange rate would be. In other words, you will be given what that forward exchange rate now. Once you buy that forward contract, once you sign that forward contract, you will be told exactly how much or what the exchange rate will be in 3 months when converting euros into dollars. So this is known as a currency swap. So in this case, you don't do a spot and you don't do a forward, but you do a currency swap, which is a combination of spot and forward into one. So that combination is known as a currency swap. In other words, that is exactly what your book says right there. Agreement to reconvert back the euros. Let's see here what, I can't read that. So I just have to bring it down. Yeah, conversion of one currency to another currency at one point in time. Agreement to reconvert it back to the original currency at a specified time in the future. The rates of both exchanges will be agreed to in advance. It involves a single transaction. That's exactly what I said. It's a combination. It's a single transaction in which traders agree to pay or receive stipulated amounts of currencies at specified rates. So, you know, in that single transaction, all what I'm going to be signing for or the contract that I will be drawing here is simply saying, okay, I'm going to purchase, let's say 1 million euro today to buy $1 million worth of European bonds. I'm going to purchase 1 million euros today, and I want to sell that 1 million euro in 3 months and buy dollars with it. And all of this is done in one contract, one transaction, single transaction. And this is known as a currency swap. So is this clear to everyone? Does everyone understand what a currency swap is, what a forward contract is, and what a spot contract is?
Yes.
Very good, excellent. So basically, as I said, it's very, very simple. It really it's straightforward. It doesn't need much explanation, basically. That's all it is. As I said, even though your book probably spends 10 or 12 pages going over these things, in my book, I really don't spend much time over this. I just explain them very briefly to make sure that students understand what they are, and that's it. And I use the pages of the chapter to go over other important aspects of foreign exchange. So anyway, let's look at the importance of these three transactions, different types of transactions in foreign exchange markets. And these are average daily volume, by the way, measured in billions of dollars. So the largest transaction has to do with foreign exchange swaps. That's the largest, which is close to about $2.3 trillion a day. The next one is spot transactions, which is, again, very close to the foreign exchange swaps, but less. The third is forward transaction, a lot less than the two above, 680 billion compared to 2 trillion and 2.3 trillion. It's a huge difference. And the fourth one, which we really didn't deal with, is foreign exchange options, which is about 337 billion, which is not that much. So you can see that foreign exchange swaps account for about 42.7% of the total volume of trade. Spot, 38%. Forward, 12%. Options, 6%. So that gives you an idea about the importance of each type of transaction. So a lot more goes into currency swaps. Okay, this one, of course, interbank trading. Well, it comes really on both comes under both retail transactions as well as wholesale transactions. So you see banks doing retail transactions, which are usually transactions less than 1 million. And they're also involved in wholesale transactions, which are usually transactions way, way above $1 million in value. Now let's look at the top 10 banks that are actually involved in foreign exchange markets. The top bank here is Citigroup. And Citigroup happens to capture 16% of the global foreign exchange market, which is a huge number, by the way, 16%. That's not something to, discount lightly. It's a huge number. And then comes Deutsche Bank. Then you have Barclays, UBS. Does anyone know what UBS stands for? I guess it stands for the United or Union Bank of Switzerland, if I'm not mistaken. That's what it stands for. And then you have the HSBC. Anyone knows what HSBC stand for?
The Chinese bank, right? I forgot what it stands for.
Yeah, it's the Hong Kong Shanghai Bank Corporation. Okay, so I don't know, by the way, who owns it. I don't think it's the Chinese who own this bank, but I may be mistaken. I don't know. All I know is that it was formed in the 1960s by British investors. But today, I don't know. Maybe, you're right. Maybe now today the Chinese own that bank. I have no idea, so I really don't know. All I know is that it's the Hong Kong Shanghai Bank Corporation. And then you have JP Morgan. And then you have the Bank of America and Merrill Lynch. And then you have the RBS. Anyone knows what RBS stands for? That's the Royal Bank of Scotland. Royal Bank of Scotland. And then we have the BNB. Anyone knows what that stands for? BNP. That stands for the National Bank of Paris. And then next to it, you see the word Barabbas. What does that mean? That simply means the Paris business district. So PARI stands short for Paris, basically. And
What does ceteris paribus mean?
no, ceteris paribus, that's a different thing. That's a Latin.
Oh, okay.
Yeah. Ceteris paribus means leaving everything constant or keeping everything else the same. That's
Yeah, because I learned that from my last econ class before.
Yeah, that's complete. That's a Latin phrase which means keeping everything else constant.
Okay.
Yeah, but these are simply abbreviations. The PARI, that stands for Paris. BUS stands for the business district of Paris, basically. That's where the National Bank of Paris is, in the business district. Probably they have so many branches, I guess. So that's the one. And then you have the Goldman Sachs. So that's basically. Now, the exchange rate. How do we define the exchange rate? This is very, very important how we define the exchange rate, because the exchange rate can be defined either by the price of the domestic currency expressed in terms of the foreign currency, or it can be defined in terms of the foreign currency expressed in terms of the domestic currency. So this is very, very important. Always when we talk about exchange rates, we need to know, how are we defining the exchange rate? How are we expressing it? Now, for our purposes, we will always express the exchange rate as the domestic currency per foreign currency. In other words, we want to look at the exchange rate between, for example, the US and the Eurozone as dollar per euro, and not euro per dollar. Is this very clear? Okay, I guess so.
Yes.
So exchange rate is simply defined as the price of one currency in terms of another. And you could also, I mean, in as far as the value itself, it really doesn't make any difference how you define them, whether, dollar per euro or euro per dollar. That's really not the issue here, because you will always get the same answers, whatever rate or whatever definition you want to use. The only difference is we want to know what would happen to the currency. Does it increase in value or does it fall in value as it increases or decreases? Now, this will make a difference on how you actually define the exchange rate. It makes a huge difference. So, for example, if we define the exchange rate as simply the dollar per euro, then if there is an increase in the exchange rate, then we say the dollar depreciates. And if there is a fall in the exchange rate, then we say the dollar appreciates. Now, if I define the exchange rate as euro per dollar, then if the exchange rate increases, the dollar appreciates. And if the exchange rate falls, the dollar will depreciate. So you see the difference here? Why it makes a difference in how we define the exchange rate? So again, we will always define the exchange rate as dollar per foreign currency, or domestic, this is the dollar, domestic currency per foreign currency. So the exchange rate basically simply tells you the number of units of foreign currency required to purchase 1 unit of a domestic currency. That's basically what the exchange rate is. And you will always find exchange rates quoted in the business section of major newspapers, such as the Los Angeles Times, the Wall Street Journal, the Financial Times, the Economist. You can always find those to actually quote for you what the exchange rates are. So just let's look at one example here. And as you can see, this newspaper or journal, or whatever it is actually quoting exchange rates in 2 different days. I guess it's October 29 and October 30th. And the year is 2013. So Tuesday is October 29, Wednesday is October 30th. And here it is obviously showing you the exchange rate defined in both ways, here in US dollars and here per US dollar. So let's look at Argentinian peso, for example. On Tuesday, the value of the Argentinian peso is given as you can purchase 1 peso for 0.1698 cents. So very, very close to 17 cents, but not quite. Now remember, when we're looking at foreign exchange rates, usually they are expressed in 4 decimal points. Very, very important. You can't just use 2 decimal points to actually determine what the exchange rate here, because if you do that, then obviously, you will get the same number here. So you will have 17 cents here and 17 cents there. It doesn't work. So you really need to take it to the limit, basically. And that's what you see in foreign exchange rates. So you can see that the Argentinian peso on Tuesday was worth 0.1698 cents, and on Wednesday it was worth 0.1693 cents. So what can you say from these numbers? Has the Argentinian peso appreciated or depreciated? In other words, you can see here that I can buy an Argentine peso for 0.1698 on Tuesday. On Wednesday, I can buy it for 0.1693, which means I need less US dollars to purchase Argentinian pesos. So what has happened to the Argentinian pesos from Tuesday to Wednesday? Come on, this is very easy. You don't need to think about it.
Appreciated.
What's that?
Is it appreciated?
Appreciated or depreciated?
Depreciated.
Oh, sorry, depreciated.
Depreciated, very good. The Argentinian peso has depreciated because here I require 0.1698 cents to purchase 1 peso. Here I only require 0.1693. So just focus on this last 2 digits, 9893. So obviously there's less cents going into purchasing peso, which means that the peso has depreciated. What has happened to the US dollar? Come on, you don't need to think that hard.
Appreciated.
Appreciated, correct, appreciated. Okay, now let's look at it the other way. Now we want to look at how many pesos we need to purchase $1. So on Tuesday, we needed 5.8901 peso to purchase $1. On Wednesday, we needed 5.9053 pesos. So which is greater, this or this? The one on Wednesday or the one on Tuesday?
What's the question again, Professor?
Yeah, the question is, what has happened to the Argentinian peso from Tuesday to Wednesday?
Depreciated?
Depreciated, exactly. Because here you're requiring more pesos to purchase $1. You're requiring 5.9053. Here you only require 5.8901. So obviously you're going to be requiring more pesos. When you require more pesos, that means the value of the peso has fallen. And you can do this with all other countries. Let's look at China here, the yuan. Okay, now to purchase one yuan on Tuesday, you required 0.1642 cents. On Wednesday, you required 0.1641. So what happened to the Chinese yuan?
Depreciated.
Very good. Depreciated. That's exactly what it is. Depreciated. Now here, of course, we can do the same thing and we're going to find the same answer. Here, of course, we require 6.08961 to purchase $1. Here we require 6.0946 to purchase $1. So what has happened to the Chinese yuan? Depreciated. You needed more ones here to purchase $1. Okay, so that's basically, you know, it's straightforward. Reading them is not that difficult. You can read them and you can determine exactly what has happened to the currency in question. So it's that's the easiest thing that you can do, is read quotations. Not that difficult to do. Okay, here, of course, when we talk about currency appreciation, what we have in mind when we say that the currency has appreciated, that means it has increased in value. It simply means that you can buy more of the foreign currency with fewer units of your own currency. That's what we mean by appreciation. Depreciation is the opposite. When a currency depreciates, that means it loses value. That means now you would require more units of your own currency to purchase one more unit of a foreign currency. So that's basically what currency appreciation, currency depreciation means. Now, how about if we're looking at cross-exchange rates? What does that mean? Well, when we talk about cross-exchange rates, what we have in mind is simply trying to determine the exchange rate of one currency versus another from the exchange rates of two other countries' currencies. That's basically what it means. In other words, deriving the value or the rates of, let's say, for example, if you're given the exchange rate between any two currencies, such as Swiss franc and British pound. And, you know, from these rates, you are asked to define or to measure the currencies in terms of a third currency, the dollar, for example. In other words, the British pound versus the dollar, or the Swiss franc versus the dollar. A good example here, you know, does everyone see what I have written here?
Yes.
Or do you want me to make it? I don't know if no, that doesn't really do anything. Anyway, what I have here is the exchange rate between the dollar and the euro. So 1.20 equivalent to 1 euro. That's the exchange rate, dollar versus euro. $1.20 per euro. And here I have the exchange rate between the euro and the British pound. I'm using the letter L to refer to the British pound. So just write it down in your notes so you don't forget. In other words, another exchange rate here is given as 1 British pound, 1 euro, 1.10 euro is equivalent to 1 British pound. So from these two exchange rates, I'm asked to find what is the exchange rate between the dollar and the pound. Now, I don't have dollar and pound here. All I have is dollar and euro, euro and British pound. But I don't have dollar and British pound. So I can actually find the rate between the dollar and the British pound. So I put a question mark here. To do that, all what I need to do is take the exchange rate between the dollar and the euro and multiply it by the exchange rate between the euro and the pound. So if I multiply those two exchange rates, what am I going to get? You can see the E's are going to cancel out, correct? Because dollar over E times E over L, the E's cancel out. Does everyone see that?
Yes.
Okay, when the E's cancel out, what am I left with?
The dollar sign and the L.
Very good. Dollar per British pound. Dollar over L, which is dollar per British pound. That's what I have. So this would be the exchange rate that I would get if I multiply 1.20 by 1.10. I'm gonna get dollars per pound, which would be $1.32 per British pound. Everyone got that? Very simple, by the way. It's not that difficult. And there's going to be a question like this in the exam. So you can write that down. And remember last time we talked about 4 questions that you will see. Now today, I'm going to give you another one. This one right here. There will be another question. Cross exchange rate. You will be given 2 exchange rates like this one here, and you will be asked to find a third exchange rate. Okay, so that's basically what we will do. And we have done all of this. So, you know, all these things is just a repetition of what we talked about in terms of a spot market, forward market. Of course, future markets we're not interested in, so we're not covering this. So yeah, spot market, forward market, you all know what that is. And I really don't need to go into that. This one you don't need to know because it simply tells you the difference between a forward market and a future market. Since we are not interested in future markets, then you can cancel this table altogether. I have to look at it. Now, this one, of course, is something that we need to look at. And no, even this one, I don't think we need to look at. Forget that one too. Don't worry about it. This one, forget it. Don't need to forget this one. This one, I don't need to look at it at all. This one, no. Options, no. Yeah, this is where we need to start next time. Exchange rate determination. So we will start building our model from here. And I'm going to post a few notes for you from my own book, which should help you with the model's assumptions and how we're going to put this model together to actually determine exchange rates. Okay, so that's about it. We're going to leave it right there because we really have only 1 minute left. And, you know, it's, if anyone has any questions, I'll be more than happy to answer them for you.
Homework is due. It was due today. No, yesterday, right? The homework.
Yep, on the 12th. The homework was due on the 12th. So if you submitted it today is the 13th, right?
The 12th is today.
Is it
12th
today?
is today.
Oh, okay. The 12th
Yeah.
is today. So you're fine.
Oh,
Yeah.
okay, cool.
Mhm.
Just checking on that.
Yeah.
And then so you're gonna make the changes on titanium for homework 5 and 6.
Yes. I will make the changes there.
Okay, awesome then. I'm good.
Now,
Thanks, Professor.
Yeah, no problem. One thing about the recording, I will probably have to sees this recordings for the simple reason because I don't think many of you are actually finding them useful, because I see that a lot of you are not viewing those recordings. So, you know, if that's the case, then I think, you know, I'm just wasting my time actually, you know, spending time recording this, because it takes time. And
No, it's good. Professor.
I like
Yeah,
the
I'm
Yeah,
watching
recording.
them
it's
too.
good.
well,
Yeah,
okay,
I'm watching them on
okay.
YouTube.
Yeah.
So
Because
It's good.
I felt that many students were not watching it, so I thought that maybe, hey, it's just a waste of time. But you know,
No, it's
if you
good.
feel that it's good, then I'll leave them.
It's
Then
really
I'll-
helpful
Yeah.
when we're doing like homework or something, and then there's like something that we just like are struggling with. Because at least for me, like I'll get to a point and I'm like, I know we did this, but why can't I remember how to do it? And then like going back to the lecture really helps me, because I feel like in lecture I know it really well, but then like maybe like the next day I'll like forget a portion of it. So I really like the recordings because it helps me a lot.
Okay, that's good. That's good to know. So no, I'll keep them then. That's no problem. Any other question? As I said, I will also post some notes for you from my book, so it should help you, especially, you know, when it comes to the arbitrage that we talked about. It's a little bit complicated, but you're going to need the notes as well as you're going to need the recordings, that's for sure, when it comes to arbitrage and explaining what it's all about. So it's very, very important to do that. Okay, apart from that, I think, you know, you should be fine. And now is the time to, you know, start reading the chapters. Is very, very important. And just focus on the things that I told you to focus on. You don't have to worry about the things that we are skipping. So don't leave everything to the last minute, because then, you know, you're going to find yourself pretty much overwhelmed, and you won't be able to do much. So start, you know, taking things from now. That's my advice, I guess. You know, you better start early and just focus on those things, and focus on the problems that I presented you with, as well as, you know, there will be extra problems that I will be giving you. You don't have to submit anything. So just for practice, I will be I will be posting some problems for you. I will not post the solutions right away. I will simply give you the problems, look over them, see if you can solve them, and then I will post the solution. So you can compare whatever you did with the solutions. And those are important as well, because you will see them in the final exam. So I will post probably about 4 or 5 problems. Has to do with arbitrage and has to do with UIP and CIP, uncovered interest parity and covered interest parity arbitrage. So those are the 2 things that we will look at next time. Okay, so that's about it. If no one has any more questions, I'm gonna leave you now.
Thank you, Professor. Have a
Thank,
good weekend.
thank you. You too. You have the same, and don't work too hard. At least, you know, enjoy the weekend a little bit. Don't just focus on reading and studying. Keep some time for leisure as well, so your mind can work better. Okay, guys, thanks a lot. See you next time. Have a nice weekend.